We'll get started. I've been hearing that whistle blowing, so we've got quite a bit to get through, and I just don't want to have you guys miss out on some of the key elements of the presentation here today. Thank you so much for joining our session. My name is Barry Shrosbree. I'm from One Life. It's our second year as a sponsor at the Fairbairn Consult. We were last year in Cape Town. It was really amazing to spend time with you guys there as well. We've got this competition running. I'm not going to go through a lot of detail on it. There's one person from each session that's going to get an opportunity to be drawn and win this lovely little gift. It's a nice little notepad portfolio, and it's got this awesome little built-in wireless cell phone charger for your smartphone. So if time permits at the end of the session, we'll try and do the draw inside the session, but don't stress if you don't. During the course of the day, we'll reach out to you if you were the person to win this gift. Okay, so let's get started then. Today, I'm going to be sharing some thoughts on what you can do to manage today while preparing for the future. So in other words, holding today in one hand and tomorrow in the other. Now, at last year's conference, I spoke around digital enablement and how it can help you grow your book, and I showed how our digital solution, One Life Vantage, helped so many advisors, even through that difficult period of COVID, have some incredible growth. And it was simply about making it easier to do business and making things simpler. Today, I'm going to focus on practical activities that you can use and do in your daily activities to try and drive profitable growth in your business. So some of what I'm going to be sharing might be practiced by a number of you, and that's fantastic. But I can tell you through our engagements with various IFAs, there's a number of people who aren't necessarily utilizing all of these little tips and tricks of the trade, so to speak, to get the full benefit of it. So I'm hoping there's going to be something of value for everyone in the session here today. That'll be really fantastic. And not for it to just be a rah-rah session and we'll just sort of whirlwind through this thing and in 2 weeks' time we forget about it. So let's start here then, and a saying that I'm sure a number of you would have come across at a point in time, and they say that revenue is vanity, profit is sanity, but cash flow is reality. And no more true word could be spoken when it comes to business. And the challenge for many of us is that we grapple with this thing all the time, right? And so often we have to focus so much on our current cash flow reality that we simply don't have enough time and focus and energy to be able to place onto the future and how do we drive that future profitable growth. And so faced with that reality then, how do we future-proof our business? What do we need to change today, now and then moving into the future to capitalize on this? So in a recent Deloitte Insurance Outlook report, they say that there's really a significant change that's happening right now underway for all of us. I'm talking insurers and advisors alike. And so we need to proactively take control of our own transformation and destiny. And the context of transformation that I'm talking about here today revolves around the need to generate new value. It's meaning to unlock new opportunities, to drive new growth, and really just capitalize on all these new efficiencies available to us. However, there's a double-edged sword in transformation and growth that we're really faced with, and that's inflation. You see, in South Africa, we know that's quite a significant contributor to this insurance protection gap that we're faced with. In fact, as South Africans, we had only enough life and disability insurance to cover around 45% of our household expenses in the previous year. So the upshot here, though, is that it tells us there's significant opportunity out there to be had in the market. On the other hand, I did say it's a double-edged sword. And so high inflation also then puts pressure on retentions, a bit of a squeeze on the consumer in terms of their cash flows, right? And so that then in turn can have a negative influence on your book size growth. So I'm going to share a couple of examples that we found to be quite effective of how we defend against some of this impact, and it's been quite successful. But let's first quickly remind ourselves, why would growth be important? And it's simply this. Business or book valuations are based on your future cash flows, not your current cash flow. So if you're looking at building a business or a book that you can extract value from over time, it's important that we have that resilience built into our business so that we can stand today's pressures as well as then create opportunity for the future. Now, to build a more resilient practice, we can do so in 4 specific areas according to research, and that is financial, operational, digital and technological, and organizational resilience. So I'm going to discuss very high level some aspects of these and give you some pointers on how you can build resilience on each of them, together with some practical insights and thoughts, and pairing them with some examples along the way. And now these pointers, I can tell you, it mainly comes from what we can share from our own One Life perspective internally in our own business that we apply, but also through our engagements with IFAs in the market as well. I'm going to focus primarily on those first 3 though. It's just not enough time to cover all of them in too much depth. Okay, so firstly on financial resilience. You'll remember this quote on the screen from earlier. The bottom line is when it comes to financial resilience, you can't build future growth if you're constantly operating with a cash flow shortage. And at some point in time, I'm quite certain all of us have been there, right? There's a bit of a financial squeeze, whatever it is that caused it, but we desperately need that cash inflow to come quickly. So one thought that you can look at is partnering with insurers or carriers that pay regularly and early enough so that you're not left in a compromised position or wanting when you desperately need that cash flow to be coming in. So at One Life, for instance, and I appreciate that it might run differently at different businesses, but we pay out daily commissions. And it's in order to help defend or protect against this particular problem that folks have. And we found that in our research, when we brought our offering to the market, this was a major pain point for many advisors. So that's one thing, but actually more importantly when it comes to financial resilience is being proactive with the management of collections. And why we want to do this is we've got to actively intervene before a policy lapses and then triggers a clawback. And we know the impact of a clawback, right? And how it hurts us sometimes from a cash flow perspective. Now, I personally believe your insurance partners can and really should help you with this proactively. And so the question you've got to ask is, are they actually doing that for you? And what are they doing? Are you getting the support? Now, I can tell you we've seen in our business at One Life savings of an average around 15% on the lapse and end-to-year experience. And it's simply because of the proactive reporting that we provide on things like missed premiums. So what we'll do is, with our IFA partners, we'll help show what do you focus on in terms of your missed premiums. Where's your biggest pain going to come from? What's the propensity of a policy to lapse? What's your highest commission risk and so on? And based on that, we've formulated a plan together to try and help keep those policies on the book. And the reality is it has saved advisors on average to the tune of around 10,000 Rand a month in saved commission by just being proactive about this. All right, so moving on to the second pillar, operational resilience. Looked at a number of scenarios, but I settled on just unpacking two very quickly here today. One is to increase your sales, and the other is to reduce your cost base. Okay, well, Barry, that's all fine and well on paper. Sounds quite obvious, but it's also easier said than done, right? But I would ask the question, why can't we actually do both? So let's look at this simply, right? There's an acquisition cost to you as an advisor for every single policy that you put on the book. If you consider this is the cost of you doing business, think about your expenses. It's franchise fees perhaps, maybe there's compliance fees, marketing, telephone, travel, your petrol, and a whole telephone list of other expenses all built in. And of course, your cost of your time. How do you even put a number on that sometimes? So when you add all of these expenses together and you divide it by your number of policies that you're writing on a monthly basis, you can now determine what is your personal acquisition cost per policy. It'll be different for everyone. And then from that, you can establish now what is your real profit per policy, right? Income, I think Guy mentioned it earlier, income minus expenses actually equals your profit. And that's just simple economics behind it. But what if I told you now that we've got, okay, that's step one to determine what your current profit number is, you could increase that profit number by around 20 to 30%. And it's not by upselling the clients a high amount of cover. An easy win here is decrease the amount of travel costs, as an example, by reducing the number of ongoing appointments that you need to conclude business and those follow-ups and the like. So how would you do this? Digital resilience. It's as easy as that. So for instance, our digital solution has actually reduced the average industry acquisition cost down by about 1,500 Rand. So we do this by reducing the amount of time spent on all those interviews, admin burdens and the follow-ups and the travel expenses and the like, all those hefty costs. And that immediately increases your personal profit per policy by that same 1,500 Rand. Right? So just very quickly, a policy of say 500 Rand, if you were to do the math on it on RegCom, an extra 1,500 Rand in your back pocket equates to about a 30% increase in your profit. All right, so this is something that's simple, but it's a highly effective cost reduction benefit that you get. So that's one. How about increased sales? So this is really the flip side of the very same coin. So it's a nice, easy one. Now, the way you do this is minimize your consulting time. So if the average interview, travel time, prep work, and all of that's involved in selling a policy to a client takes about 4 hours, right? And if you're working a 40-hour working week, you can then practically see 10 clients a week, all right? But if you reduce the time spent on each of those activities and you can close a policy on our platform, as an example, in 35 minutes, now that means you can consult 2 to 3 times as many clients as you would have before. And effectively what that's going to do is it's going to help you scale your practice quickly. You're going to increase your commissions and your cash flows. And quite frankly, you're going to spend more time on the activities that count and less time on the administrative burden that doesn't. Okay, so again, great on paper. You've got a nice process that can help you make more sales and you can do it quickly. But how do I fill the bucket with more prospects, Barry? Where do I get these people from? That's still a problem, right? So let's talk about lead generation for a moment and specifically marketing around it. So here, when you're competing with other brokerages or brokers in your area, your win rates naturally diminish, right? So we need to think about tactics that you can put more leads into the bucket now and over time. And you can achieve this quite simply through brand building. An interesting piece out of LinkedIn research actually showed that buyers that were exposed to brand marketing and awareness increased their email response rates by 150% versus when they didn't. So what it requires, though, is a bit of a change in mindset and moving from a client acquisition approach or mindset to one of a growth. And there's actually a subtle difference between the two. See, customer acquisition by its very nature is a short-term tactical exercise, whereas the growth approach is more of a medium to long-term strategic play, where you're going to get the benefits of longer-term sales opportunities over time. So we've got to start thinking strategically around medium to long-term for that bigger opportunity. And you do it by realizing the importance of your personal brand and growth and your reputation, of course. It's going to yield better results in the end than rather just chasing our tails month after month for just pure customer acquisition. All right, so to give a better perspective then, let's turn the sales funnel on its side. It's also probably a familiar type thing. We just flipped it down. And you can clearly see your in-market customers on the left-hand side. That's for your short-term cash flows, the guys in the market to buy today. And then your out-of-market customers, that's your future prospective clients on the right-hand side. And so what we've got to do now is start by plotting all of our clients and leads and the like in this way and devise purposeful strategies and tactics to move clients down the funnel from this stage of being out of market into this stage where you're going to get a much higher hit rates on closing the deal. So for example, those in-market customers that we saw on the left-hand side, those are people that have already decided to buy. They've evaluated you, they're at that buying point already. And I'm sure we can agree, those are probably the ones that you've got a high likelihood of success to close the deal. But for your out-of-market buyers, it's a totally different story. See, these are clients that they are still information gathering, so brand awareness is really critical and something that we've got to focus on here. So something you can do as an example is leveraging things like videos and client testimonials that you can do to move those clients from that out-of-market space into the more current cash flow situation. Or maybe even leveraging other marketing collateral. So, for example, at One Life, we'll support IFAs to say, well, here's some approved brand content that you can use, and that's going to help you fill the bucket in the top and as well push them down the funnel to that buying decision stage. And again, just one last interesting fact that also came out of that LinkedIn research is that there's a 6-fold improvement on sales activation when a client has been exposed to brand marketing and awareness together with lead generation as opposed to just a pure lead gen play only. So the short takeout here and all of this brand stuff is the following, is that if we get this and focus and get it right, you're going to get more of your top of the funnel guys, but not only that, you're going to increase your success or your hit rate along the way. All right, then we come to the question of whether to diversify or not. Now, the reason I included this is another interesting thing we've observed is there's so many guys that are maybe focused on only one niche product. Maybe they only want to sell risk products as an example. Excuse me. But they're missing out on like huge opportunities. See, big business leaders have recognized this, and that's why you'll have, take an example of the banks. Banks don't just offer banking, right? They've gone into diversifying to complementary products and services. So they'll do banking, they're going to do insurance, they're going to do cell phone, etc. There's a whole long list of things that they're going to do because they've realized that that is the opportunity and they need to go into these new categories to get that sustained growth. Closer to home though, how does that apply to us? Right, so perhaps you've got a client might not be right now in the market for a risk product, but they're at a stage where they need an investment. Well, alternatively, everyone needs some form of estate planning. And so if we just diversify our offering a little bit more to include these various things, you can enhance, number one, your client's experience, but more importantly, and at the same time, you get to take advantage of all these different cash flow streams that's going to come to you over time. Excuse me. And now I've included this just as a quick example of a way of diversifying because I think it's a great enabler of diversification. So we, in April, launched our own One Life Wills and Estate Plan product. And there's fantastic benefits built in. I'm not here to talk about the benefits of the product and what there is in it for the client. There's amazing stuff for the client now and over time. But for you as an advisor, there's amazing benefits as well in these kinds of products. You see, you've got the potential for the cash flow today, right, as well as the cross-sell and upsell opportunities, because there's triggers built into this product and process that says, hey, this is the right type of product at this point in time that you can now go and do a cross-sell as an example to the client. And in addition to that, you also get future cash streams coming in by way of, there's attractive executive fee sharing arrangements as well that's built into this. And so when used properly, you can create multiple cash flow streams from the very same clients, basically creating for yourself a client for life. But most importantly, you don't disintermediate yourself out of the process by passing that along to some external third party to do that part of the sale for you, because then you're out of the loop and they're going to do the cross-sell opportunities. Then besides different products, another way you can diversify is geographically, right? You've got the likes of Team and Zooms and all these good things nowadays with technology, and even coupled with our remote acceptance. There's no reason not to look at geographical expansion anymore. You can be based in one part of the country and do business in the complete opposite end without incurring, as we might have in the past, all those exorbitant travel costs. Right, so take for example, if someone's based in the Western Cape, the economically active universe available to you is 2.3 million clients. I'm not saying those are all prospective clients, but you get my point. More importantly though, is that there's a 6.5 times roughly bigger pool of clients available to you. It doesn't matter that they're not in your province, right? Because with the likes of social media platforms and some of the brand building stuff we've spoken about today, you can reach these audiences a lot easier than it would have been in the past. The thing is, we've got to challenge our traditional way of thinking and say, okay, how do we lift some of those constraints to capitalize on this opportunity? Now, a lot of what I've covered here today has already got an interrelatedness to this topic of digital resilience. So if you've started digitizing already, that's fantastic. Now it's a case of enhancing from having laid the foundation to get into a space of value realization. So I think it's worth just taking another high-level look at how all of this comes together for those of you that might not be fully familiar with our platform and One Life Vantage. And it really just shows how and why all of this that I've spoken about is possible. So firstly, you've got a built-in financial needs analysis and record of advice. There's real-time underwriting that takes place on our platform with straight-through processing, right? Meaning we can give you a result on the spot. You don't have to send the client and wait for medicals to come back before you can conclude something. Then we've got affordability modeled on top of our life stage planning in the F&A. Why that is so important is in this economic climate where people are stretched, we've got intelligence built into the recommendations to say, how can you defend to an extent or a degree on lapses? You've got remote acceptance that comes via an OTP process, so you don't have to see those clients face to face. And all of that really can culminate in a conclusion of a policy in a space of 35 minutes. Okay, so that brings us to the end of the presentation. I thank you guys so much for your time. I hope you have taken something of value out of the session and enjoy the rest of the conference. Thank you, folks. Cheers.